Cool. All right, let's jump in. Well, everyone, thank you again for joining us for another investor webinar presentation. Very excited for today's guest, Ben Myers, who is an analyst, an expert. He's the go-to person for media, developers, investors, anyone who wants to learn about real estate. He's the guy. He's the president and owner of Bullpen Research and Consultant, and thrilled to obviously have you on as a guest because there's a lot of questions about what's going on in the real estate today. There's a lot of noise in the market that isn't necessarily accurate, and I think people need to see through the headlines and read through the headlines. So I'm really excited. So we're going to talk about some real numbers, and for me as an investor and helping my clients invest, I'm always talking about, don't focus on the numbers today. You need to look at the numbers from the past, and you need to look at the numbers from the future. And I think that's probably what we'll get a lot out of today. So thank you for being here. I know it was tough to get you. You're very busy, and I'll just do a quick little intro for you again. With over 20 years of real estate research experience in the United States and Canada, Ben has established himself as an industry expert and a go-to source for the latest information and insight on the domestic residential housing market. Bullpen Research and Consultant, a boutique real estate advisory firm founded by industry veteran Ben Myers, created to help better understand the residential housing market in Canada with a focus on new development in Ontario. You've obviously been very, very, helped a lot of people in all areas of residential real estate. Maybe just mention some of the relationships and some of the things that you help with developers. Because I mean, that's really, developers are coming to you to help find answers as to pricing units and what to, if it's a good buy for them to buy in this market. What does that whole process look like?
Perfect. Well, thanks. First off, thanks for having me, Ryan, and I appreciate you inviting me on again. And yeah, so Bullpen Research and Consulting, we essentially work for primarily three groups of people. Residential developers, lenders into the residential development space, and landowners. So. For the most part, the majority of my studies are for developers. So they come to me with a project that they may be, just looking to purchase. Maybe they're in the due diligence process. Maybe they've already purchased it, and then they're going out to source some debt, or some going out to find equity partners, or maybe they're already in the the process of putting in their development application. They want to know what the unit mix they should have in their project, or they might even be weeks before launching. They just want a second opinion on the pricing that they set the development on. So I do condo market studies, rental market studies. I make recommendations on the revenue of the project, the unit mix, the unit sizing, the floor premiums, the parking, the amenities within the suites, amenities within the building. I make forecasts on rent growth, on price growth, and then I help underwrite developments for lenders if they're looking to provide debt services. I will try to give my opinion on the revenue within the pro forma. And then I do work with some landowners as well that are looking to sell their lands to developers, and I give my opinion on what I think a developer would be willing to pay for that land. So it's a interesting mix of clients, from the most well-known and largest real estate investment trusts to someone doing their very first project that needs a little bit more guidance. So yeah, it's certainly been an interesting process over the the 5+ years that I've been in business here, and in the 20+ years that I've been doing real estate research in Ontario. So
Awesome.
I I don't think there's any more interesting market to cover than Ontario, Greater Toronto area, and specifically the city of Toronto.
Yeah, I can honestly say when you've got something in the news or there's a report release that you're involved with, I'm always reading it, and it's always very in depth. And then, again, like I mentioned, the headlines. It's like there's so much more than the headlines. You really need to look at the data and read the actual numbers. And I think that's what you do incredibly well. So I'm really excited to jump in. So, a quick agenda. This is going to be recorded for any of you joining us. So we'll go through it as quickly as we can, but we'll also send out a recording. We're going to talk about Toronto, pre-construction condos, and why investing in the Junction, and that's going to be a presentation by Ben Myers. I've been investing in pre-construction condo for many years. I've had incredible amount of success with it. So have my clients. It's something that I'm very passionate about, and I think it is the easiest, most lucrative, and safest way for people to build wealth through real estate. So I love that I have Ben here to talk about a market that I'm interested in and really break down the numbers as to why I think it's such a great market and opportunity. And then we're going to look at an exclusive investment opportunity to our Connect Insiders. It's a deal that I've negotiated with the top builder and somewhere where I'll be investing. And then we'll get into the investor operating system and how I've built $100 million real estate portfolio. And, I look at the data that Ben is going to present to us. And this is what I look at to make decisions on where I should be buying and investing based on long-term growth. And all of those fundamentals kind of come into the system that, I've created that really, really isn't difficult. It's really about making real estate simple. And then we'll take a look at my portfolio so you guys can see this all in action and how buying an investment in a building like 316 Junction has been part of the whole process and strategy of my portfolio growth. Jump right in, Ben.
Yeah, so we're just going to take you through a number of charts here that look at both the macro and the micro level, implications and data on that can help any investor make a more informed decision. So, I mean, probably the two biggest things that you're going to look at in any real estate market to make a decision on whether you want to invest in that market is the population growing, are more people coming to that market? Is there that fundamental underlying growth? And the number two thing is if someone's going to buy a house or be able to rent a new property, where they're going to have a job, right? So those are the first two charts here, and just give you a sense of where we're at in Canada and where we're at in the province of Ontario. So, you can, if you look at this chart, it looks, the very first chart, it looks very, very strange. You've got this, population change, and the black line there is Canada, and the kind of teal line there is Ontario. And really over the last, almost 20 years, but I think I have 1995 to Q1 of 1995 to Q1 of 2023. Canada was averaging annual growth of about 360,000 people. So population was growing 360,000 people net. So we're getting immigration in. We're having obviously deaths, and we're having out migration. So average about 360,000. So we were really getting ahead of that long-term average before the pandemic, and then obviously the pandemic happened. We had, essentially the borders shut down. People could not come into the country. And what has happened since has really been remarkable. The population growth, the annual population growth as of Q1 2023 was 1.05 million. So just, unbelievable amount of people. Even some of them are already here. I mean, they were, graduating universities, and they officially become an immigrant once they get their work visa. But really just unbelievable population growth in a single year. And if you just go to Ontario, you can see that a lot of them are coming here. Obviously, I mean, this is the place where there's a lot of jobs, and there's a lot of upward mobility, and there's a lot of like-minded individuals if they're coming from a country that doesn't speak English, or they want to be with their like-minded individuals just so they can get comfortable in the country. So
Yeah, and it's really
400.
interesting. I mean,
Sorry,
I've
go
heard
ahead.
numbers are expected to exceed 2022's numbers this year.
Yeah, yeah. So, 445,000 over the last year. So Q2 of 2022 to the end of Q1 of 2023. 445,000 in Ontario. In the long run, average is about 115,000. So just unbelievable growth, and part of the growth that we saw prior to the pandemic, was related to high population growth, and it looks like we will continue to see that demand in the marketplace
And
because
do you
of
know
this.
what that transpires into household formations that are needed? So
Yeah,
I always
it's
find
always
that.
it's always hard to look at household formations, because household formations is very much reliant on the number of new housing units being built, right? So it's hard for someone to start a household, or it's hard for us to get new positive households if we don't have places for them to move. Obviously, the vacancy rate is extremely low
Yeah.
in Canada, in Ontario, and specifically in Toronto. So it's not like that we can create a lot of units by reducing the vacancies. It's really, we have to increase the household. So we're certainly in a spot where we have an aging population of boomers, and they're living longer, and they're staying in their single family houses, right? So young people, their opportunity to purchase a single family home is dwindling. The new normal in the city of Toronto is living in a condominium. So that will be the way that we grow our population, is through high density housing.
Yeah, I read yesterday on Urban Nation and CIBC's report that was just released, and we're at capacity of building 20,000 new condo units right now. So
Yeah, and I got a slide in a little bit farther on where we can look at that total, that total number of units. You're jumping ahead here. So so the other key, macro trend is employment, and probably the best measure of that is the unemployment rate. You can see again with Canada in black, going back to the mid 1990s, coming out of the recession. Our unemployment rate was in Canada was 9.4%. We were a pretty high rate. That slowly went down. We had the global financial crisis, and then we saw unemployment in Canada jump back almost to 9%, and that really slowly declined for a decade. From the middle of 2009 till the end of 2019. We all know COVID happened, lots of people out of work, jumping up over 14% unemployment. But look at what's happened since. Just, shocking that we had this, massive decline in the unemployment rate in Canada, in Ontario. Especially since the Bank of Canada has been raising interest rates aggressively to fight inflation. And what typically happens when there's not as much money in the economy is for investment. People stop hiring, right? Because they can't expand their businesses, they don't have that capital available. But it hasn't stopped our market. So the unemployment rate in Ontario, lowest level in over 20 years. So really unbelievable, 4.9%. Canadian unemployment at 5% is really near record lows historically. So if people have jobs, they're going to be able to afford housing. So certainly very positive result, in spite of the Bank of Canada's moves to fight inflation, which obviously has unintended consequences of typically resulting in higher unemployment. So the fact that we continue to see lower levels of unemployment is really, it really just shows how resilient our market is.
yeah.
So when we can jump right into the city of Toronto and the Junction in terms of what's happening in the new condo market. So what you really need to understand about the new condo market is the real giant lag that we have between pre-construction sales and completions in the marketplace. So if you look at this chart here, I essentially included new condo sales from 2010 to 2022. These are the actual numbers, and then forecast. So unfortunately, the forecast for 2023 is looking a little bit light. We're looking at 10 to 11,000 new condo sales in 2023. So there's really two ways you can look at that. You can look at that and say, "Wow, the market's really down. What's going on?" But the way that I think is important for an investor to look at is we're going to have a deficiency. We already have a deficiency. We're going to see even more of a deficiency in the number of units that come to market in 2027. Based off my forecast, we're looking at 9,000 completions in 2027. So just an unbelievably low number. In years where we've, what was the year I wanted to point out? 2017, there was 17,600 completions. And because of that fairly low number, we had a pretty big run up in new condo prices in that year, right? Yeah. We had the government coming in with a fair housing plan and all kinds of things to fight the growth in that marketplace.
Yeah.
And what happened in 2015, so you can see in 2011, 27,000 sales happened in 2011. So you fast forward 4 years, we actually had 33,400 completions. And in that year, resale prices were pretty soft.
Yeah.
Growth in rents, soft.
Yeah.
But that's about one of the only years that we've had that outside of COVID. So really we essentially need 33 to 35,000. That's kind of my number. Somewhere between 30 and 35,000 completions for the market to be soft, to essentially for the market to match demand for high density housing units. So
and the average is probably around 25,000.
Yeah, and you can see, look, we've had in 2019 we had less than 14,000 completions, right? So so that was a factor that resulted in the resale market holding up all pretty good in the first few months of COVID. People had said, "Oh my goodness, like the market's going to crash." CMHC said they expected the national market to drop 10 to 15% in a year, and I said, just wait till September. Just wait till September, and all these people sitting on the sidelines are going to want to jump back in. And by September, we had
people, demand never goes away. It
Yeah.
goes to the sidelines.
It just sits on the sidelines. That's the perfect way to.
So interesting, and I think this is so important because honestly, to me, real estate has always been a very simple thing. Simple economic fundamentals of supply and demand. And when you look at supply and demand, there's two sides to that coin. You've got a demand story and you've got a supply story. What's our demand story right now? We've got more population growth, strong job market, all of these indicators that have demand stronger than it has ever been. And then on the other side of the coin, we have the supply coin, where it is terrifying to where I believe supply will be in the next few years based on what you're showing us. It is already terrifyingly low. So what does that tell you as a condo investor, as someone who owns real estate? It tells you that prices are going to go up, and it's probably a very good place to put your money. Or if you're waiting for the future, it's going to be very difficult to own real estate in the future. And that actually ties to like my number one clients right now. They used to be investors that were building big portfolios. A lot of them still are, but the number one is actually parents buying for their children so that they could have their place in the market. And they're buying something now that's ready in 6 years, and then they know that their children will be able to have home ownership, which will get harder.
Yeah, it makes sense. I mean, I think it's just looking at the the price per square foot that I'm going to show you in the next chart, and to think of young people trying to afford something like that, it's certainly going to be very, very challenging. So I just put together the median price per square foot for new condominiums in the city of Toronto. So this is based off a sample of listings data, pretty robust sample of listings data. So pricing is up 57% in 5 years. So really pretty unbelievable continued growth of over 10% a year in the new condo market. We're coming down a little bit, as you can see, from the end of 2022. We've dropped down to $1,456 a square foot. Part of that is, some of the less expensive inventories being sold off. part of that story is there's been almost no luxury new condo launches over the last few years. I mean, the last few months, going back to April of last year. And when there's a little bit slower market conditions, it's typically the luxury projects that kind of get thrown off to the side, and that don't see as much activity. But obviously, we've seen some very successful project launches. Union City would be a perfect example of that, selling out 2 buildings in a matter of I think 3 weeks. They sold out 2 buildings. I think that the demand certainly is there from investors, and some of you are those investors that are going to be watching this, but they're looking for a little bit of a discount to where pricing was kind of at the peak of 2022. So we'll see how the market shakes out. We're seeing projects that are launching now, going back to fall 2021 pricing, and they're finding great success. So it'll be be quite interesting to see where the market goes. We obviously have a floor. There's a floor in the marketplace in terms of how much a developer can charge because of construction costs. We still have a record number of units under construction based off of the extremely strong sales that we've experienced over the last few years. Lots of infrastructure projects, a lot of rental developers getting involved in the marketplace. So a lot of pressure, upward pressure on construction costs due to labor. Obviously, there was inflation issues in terms of the materials. The city of Toronto continues to increase development charges on every developer, as many of your listeners and watchers will know. They're trying to put in inclusionary zoning. They're trying to put in measures in terms of rental replacement and office replacement. So there's a lot of things that they're driving up the cost for developers, and they ultimately have to be passed on to the consumer, because developers just can't get financing unless their project makes a certain profit margin. So there's still a lot of upward pressure on developers for cost. So there really isn't a lot of room for them to come down. So that's that's an important point. See, my dog wants to really emphasize the costs are going up in the marketplace. So.
Yeah, I mean that's such an important point. Like, someone who's sitting there waiting, you're not waiting for much. And I mean, obviously there was that bit of a downward slant in prices, but and for the reasons you mentioned, that also has to do that. A lot of developers make most of their money later on in sales. So they sell, 40, 50% of their building. The first 20% is at their lower prices. They increase, and then the last, 10, 20, 30% of their building, they sell at a higher price. And those inventories aren't selling the way they used to. It's really, it's an interesting market right now. And it's, I think the important thing is just that people need to understand that those prices have been set. And another really interesting thing, just to kind of break it down a bit further, is people think developers make these large amounts of money, and they do, because they sell a lot of condos and a lot of properties, but their margins typically are around 8 to 14%. Correct me if I'm wrong.
Maybe a little bit higher than that, but 11 to 15 is basically going to be. If someone went to a bank with an 8% profit margin, they probably wouldn't get financing, right? So they still have to maintain that profit margin, and so there's a very small likelihood that we're going to see huge price declines in this marketplace, because projects are just not going to launch. Right? Developers will not slash their unsold inventory. They'll go out and get a loan for what we'll call an inventory loan. They'll rent those units out. They'll wait to sell them when the market conditions improve. So it's not like the resale market where things adjust much quicker. Developers, if they can't sell the project for what they need to finance it, then they'll just pull that project from the market. So surprisingly, we haven't seen a lot of cancellations. Over the last 12 months with the higher interest rates, we really haven't seen it, and now we're starting to see a flurry of launches, which is pretty interesting for the summer, when we typically is a slow launch period. So it really just tells you that developers are feeling a lot more confident in the marketplace.
Things have changed a lot over the last few months.
Yeah, for
The
sure, for
sales
sure. Yeah,
numbers.
there's much renewed confidence. The Q1 of 2023, a lot of people were very, very worried about
Yeah,
what was going to happen in the marketplace. But with interest rates paused, with resale, turning up in a lot of neighborhoods, bidding wars starting to happen again on the resale side. There's definitely renewed confidence from the development industry.
yeah, absolutely.
So I wanted to look at pricing in the Junction, right? I mean, that's where the project that Ryan is looking at is located, and let's take a look at how have pricing gone in the Junction in comparison to the overall city of Toronto. And amazingly, it's almost matched exactly. So 2018, $854 per square foot on average for projects in the Junction. Fast forward to 2023. $1,311 per square foot on average for projects in the Junction. So a 54% increase, so almost matching exactly what's happened in the overall GTA area. Pricing up 6% annually. So we're still seeing that price growth in the marketplace in the Junction. I think it's a hugely undervalued market. I used to live at Bloor and Kiel. I used to love going up to the Junction, and I thought, wow, this area could use a few new condo projects, and it took a few years to happen, but it's becoming a much more desirable community, and I expect prices are going to continue to go up.
Yeah, and that's why I've identified this area as one of the areas I want to invest in. I mean, a few things is because this is an opportunity in the last chart where you can see some projects you are getting some good incentives that are actually allowing you to buy below market value or potentially launch prices. And we've got this exclusive deal that we're able to do that for some of our clients. But yeah, this market, I mean, it's completely undersupplied. So that's another thing we talk about, the supply and demand story. There is a tremendous amount of demand for people to live in this area, young families, young professionals, and there just aren't a lot of condo buildings. So it's exciting to see this one come up and a few more in the pipeline. But yeah, I couldn't agree with you more. It's a great neighborhood.
Perfect. So yeah, I wanted to give a specific example. I know sometimes when numbers are blended and numbers are averaged, it doesn't always give you the full picture on what's happening. So I wanted to give a specific example. So if you're going through the Junction now, you can see that this neon Junction sign is now above this project called Junction House. This is a mid-rise development by Slate Asset Management. I remember going to this launch in 2019 and invited by my friend Brandon Donnelly, and he said the pricing was $1,000 a square foot. I'm like, oh my God, this is overpriced. He's not going to do well, but what a fantastic project. And I being someone that's even bullish on the Junction, undersold his ability and how desirable the neighborhood was. So it sold extremely well, and when it launched in 2019, as you can see, pricing up to $1,175 in 2020, $1,140 in 2021, $1,232 in 2022, and now $1,343 per square foot for the unsold inventory in this development in the first 4 months or first 5 months of 2023. That's the data that I'm looking at there. So 31% increase over the launch, and I think that's near market value. They're coming to completion on that project, and it just shows you that there is value in the Junction, and that they've continued to make sales along the way.
Yeah. Yeah, I mean, like you said, there is demand, and there's just not a lot of options. You're either going to buy a multi-million-dollar house or a condo for much less.
Yeah, so I put together a list here of new condo launch prices and the average resale value at that project over the last year. So I pulled this resale information from condos.ca. So you can see that I pulled out projects that launched from 2013 all the way till about 2018. So the increase in value total increase in value has been from about 27% all the way up to 110% increase in value. So pretty unbelievable. So sorry, I have a couple 2011 launches on there. Sorry about that. So yeah, a project like Howard Park Residences and Roncesvalles, which is another area that reminds me very much of the Junction, right? It launched at $517 a square foot in 2011, and resale units in there are 1,080. So, an average annual increase over, a 12-year period of 8%, right? Or 9%, sorry. And so the one I wanted to point out here is Duke Condos. So Duke Condos was a project completed by TAS, very good developer, strong reputation in the marketplace. So they launched their project in 2013 at about $589 a square foot. And over the last year, units in that building have been $1,169 a square foot. So a slightly larger product, which should be pointed out, or we would see an even higher price per square foot. So a 98% increase in a decade. So again, a 10% average annual increase in that project. So
that's an important point to make. So smaller. When you're looking at kind of averages for condo prices, you look at size, if it's price per square foot or whatever. Usually a larger unit is going to be cheaper per square foot. Smaller ones are more per square foot. Another variable is how old is the building, right? So something on the resale market that's appreciating at a certain rate, you need to look at the average, and that's made up of old buildings and that's made up of new ones. And the new ones are always appreciating at a much higher rate of that average price. Which I always find interesting. So, and I think that's, one of the main reasons anyway, why pre-construction actually outperforms the rest of the market. So you end up buying a premium at the beginning, but because it's a newer condo, by the time it's completed, it's appreciating at the higher end of that average appreciation.
Yeah, I mean, obviously you're like we say, you're buying a condo market future. You're buying something and betting on what the value will be at the time of completion, and you're investing in real estate without a mortgage, right? I mean, that's the best way of that I put it. You got a warranty on that product, and you've got something that's brand new, that's never been lived in, and I think those are all very appealing things. And we'll take a look at some of the other charts here that have some interesting data, and starting with the rental market. So we showed this story of high population growth. We showed this low unemployment rate, but I didn't have a chart on resale activity. But maybe I should have put resale activity in there. But resale activity is down. So interesting that we've got this increase in population. We've got people still with jobs, yet resale activity is not as high. So where are those people going? As you mentioned, Ryan, the demand doesn't go away. They're going into the rental market. So they're just a little bit worried, a little bit cautious about interest rates right now, a little bit cautious about resale values. So let's just stay renting right now. And you can see the growth has been really, just shocking, really. The average rent for a condo apartment in Q1 of 2021 was $2,077 a month. So this is all product, from studios to 3-bedroom plus den. So $2,077 in 2021. Wow. Fast forward to Q2 of 2023, we're at $3,267 a month. So just unbelievable, $1,200 a month higher than it was, 2.5 years ago. So just unbelievable, 22% year over year growth. And then just looking at the price per square foot, about $4.18 a square foot in Q2 2023. Again, this is City of Toronto. This is all product. This is not just new product. This is all
And that's
condo product
the
for
thing,
rent.
because the new product will be getting higher rents than the older
Yeah,
products.
yeah, and we can take a look at that. I think I have a slide on that, so we can take a look at where the rents are
Do you
for.
know what the growth rate actually is? So, because I know it was, I mean, the pandemic, obviously, there was a mass exodus of the city, which was something very unique. But before that, I believe the average, long-term average, 10-year average is around 6%. And I think because of the mass exodus, it's just sitting around 5.
Yeah, if looking at the couple years before the pandemic, rents were going up 7 to 9%, right? I think my forecast going into 2020 was for 11% growth, right, in rent. So what was expecting it to go up even higher, right? So we were seeing just massive growth. So there's definitely an undersupply of rental properties in the marketplace, and now with some of the demand shifting from ownership to rental, then that's why we're seeing 22% growth, and why we're seeing rents go up $1,200 for for the average condo for rent. So but
It's so important though. So because I mean, most of our watchers, viewers are investors, and the most common thing people are talking about right now is negative cash flow. And myself, I've never actually bought for cash flow, for monthly cash flow. I bought for capital appreciation, and the value in buying pre-construction, as you said before, is it's essentially a future. You're just putting down a deposit on a highly leveraged, highly appreciating piece of paper that you don't actually need a mortgage for. So then you've got 4, 5, 6 years of rent appreciation and growth appreciation. So that has always put you in a very good position, historically speaking. You can take the last 5 years, the 5 years before that, the 5 years before that, 5 years before that. If you look at the long-term data and 5 years fitting within the long-term data, you know that that is probably going to be about 7% annual growth, and you're going to have a couple $100,000. So then what you do is you can close on it, refinance it, and then use that as your cash flow. But that aside, regardless of it being cash flow, what's really interesting is we're talking about rents appreciating the way they have, and we're expecting them to appreciate at a higher rate. Right now, I just read the average condo investor is $400 a month in negative cash flow. And when you think about that, if rents are appreciating at 7% and the average condo is $3,000, within 2 years, your negative cash flow has gone away. You're also paying down a portion of your mortgage as well. So I think it's just a really important thing to point out, because it's discouraging a lot of people, and it's in the headlines and they're getting caught up on negative cash flow. But right now we're talking about how incredibly resilient and strong our rental market is and how undersupplied it is. And I think anyone worried about cash flow is not going to have these concerns in a few years.
yeah, I think anyone making an investment it has to think about what the investment looks like over a long-term period. I would never advise a client. Uh, Obviously, my clients are not investors, but I would never advise anyone to buy a pre-construction condominium if they asked with the intent to flip it. Right? My advice would be to buy a pre-construction condominium if they're so inclined, but to have a 10, 15, 20-year horizon. Hold it and pass it on to your kids for them to use it, or pass it on to them as an investment for them. I mean, I think that is the way to go about it. And I think that as high as rents are in the GTA, and you can see here in some of these new projects, they're up above $5 per square foot. They seem low when you compare them to a New York or to a Miami. A Miami developer will think that our price per square foot is super high, but they think that our rent is too low. A lot of their new product is getting $5.50, $6 a square foot, right? So, and I think that's really the direction of our markets going. If we're going to have higher interest rates, less people are going to buy, more people are going to rent, and we're going to continue to see this type of rent growth in our marketplace. It's inevitable. I mean, even with young people working from home, do they really want to live in Aurelia? Do they really want to live in Woodstock? I think they want to be in the city of Toronto, right? And even if that means, sharing and living in the den of a 540 square foot unit. I mean, I think that's just the future of our market, and that's what the sacrifices people are willing to make to live in LA and New York and Miami. And as much as people say we're not that market,
Yeah.
Toronto is an amazing marketplace, right? And I think we're going to continue to see this type of rent growth in the future.
Question for you. So I read something the other day as well, and I've been reading this for a while, and it seems to be a trend. So I used to always buy smaller units, studios, one bedrooms, because I knew they're the more affordable in the rental market, and therefore you usually have more demand and higher rent, so you get the higher rent per square foot, and it was better. And then I started seeing a trend years ago where there's obviously a lot more people moving into larger units because you can't afford houses. And then so I started buying 2 bedrooms and 3 bedroom units, and they've done incredibly well for me because they only make up a small portion of the entire inventory of a market. So that's another
Yeah.
reason. But what I'm seeing now on the rental side is that the studios and the one beds are still having very strong rental growth. But in between, like the 1 bedroom and dens and the 2 bedrooms, and then it's the 3 bedrooms that's seeing the same type of growth as the studios and the ones. And I kind of predicted this coming just because of an affordability even to rent, where now more people can share a unit instead of renting 3 separate one beds. Are you seeing anything in terms of larger units outperforming and any?
Yeah, I mean, it was obviously crazy during COVID that we saw, very strong results for some of the larger units. And again, I think part of that is people working from home, and
Yeah,
they wanted a room with a window to be able to work from, right? So I think that was part of the story. But, as we know, a lot of people are not going back to work. They're not going back to the office, right? So a lot of people are keeping that additional space. So instead of spending, whatever it is on a metro pass, and then they're downtown and they're spending $20 on lunch every single day, they're putting that money into their rent and renting some larger units.
right.
But the long term, I think you're right that trend is going to continue. That people are not going to be able to afford to buy, and they're going to be lifetime renters. So there's going to be more demand for these larger suites. And I know it's always been difficult for people to be a landlord managing 3 different tenants, but if there's a way that you can structure it to, treat each individual person as a separate lease instead of just a lease for all 3 tenants, then it becomes much more easy for someone to make a commitment to pay you, $1,500 or $1,700 a month for 1 bedroom within a 3 bedroom unit. And then, you might end up, cashing in with $6,000 a month on that 3 bedroom unit. Right. So I think there's ways for investors to be creative, and I'm not sure if you're doing anything like that, Ryan.
Exactly what we're working on right now. It's
Yeah.
exactly it. So I own a property management company as well, and we're now trying to create a business and a website where we're going to start renting rooms, and that's why we're going to start with a few of my 3 bedroom units. Because if you're renting a 3 bedroom condo for $4,500 a month, that's great. There's 3 people paying $1,500. If they were to go rent a 1 bedroom, they'd pay $2,300. So if you just rented those rooms within the 3 bedrooms separately, you could probably get $1,800 to $2,000, and then now you're making more than $1,000 more a month. So
Yeah.
definitely opportunity for that. I love that you recognize that as well.
Yeah. So interesting shifts in the marketplace. So just on that last chart, if we just look at that real quick, some of these projects are not obviously relatable to the Junction area, but just to show, like Yonge Street, $540 a square foot for 11 Wellesley. Yorkville, $5 a foot. We're talking Stanley condos on the east side, $490 a foot. Then when you get out to Yonge and Eglinton, 150 Redpath at $4 a foot, Art Shop at $4 a foot. So there's some. I only included buildings with a lot of inventory because I didn't want them to be skewed by small sample sizes. But Daniel's Lighthouse at the foot of the waterfront, $4.30 a foot. So very strong growth here, and I think that will continue to be demand for neighborhoods, a little bit more of a neighborhood feel as opposed to this chart, which really is a downtown focus. I think there's going to be very strong demand for neighborhood style rentals, and a little bit off of the downtown core where it might get a little crazy sometimes. So I think maybe young people want to be right on Yonge Street at that first rental, that first 350 square foot, but maybe their next one, they want to be in the Junction, a little bit more of a neighborhood feel, but still connected to transit. And so I think projects a little bit outside the core will continue to be very strong rental markets. I'm always surprised to even see how quickly that condo investors are leasing up projects in Scarborough off transit. I saw, I was doing a market study in the Scarborough city center area, and there were studios, 325 square feet or 335 square feet, leasing for $2,300 and $2,400 a month in the Scarborough city center, right? And they're about to shut down the subway for a few years as they build the new one, right? So it just shows you there's huge rental demand all across all across the city of Toronto, and again, I'm bullish on the Junction, so I think there's a lot of potential value there.
Yeah, I found some rents in the Junction, which I'll have a chart later on, but it's staggering, and for all the reasons you said. I mean, I believe, or I know, people want to live away from the concrete jungle. They want to feel like they're in a neighborhood. They want to feel like they're close to downtown, because that's why people are here. But the transit, the parks, and the restaurants, that's where I think people really want to live. Once they've grown out of that initial move downtown phase.
Yeah, yeah.
So what?
So again, I just put together this chart here, just showing some of the rental rates for these kind of select buildings that I had in the previous chart, these newly completed projects. So, I just put it for, 1 and 2s, but it's 1 and 1 plus dens together, 2 and 2 plus dens together. So, $2,475 a month for a 1 bedroom in those projects, $4.60 a foot in 2023. $3,380 a month for a 2 and 2 plus den, getting almost $450 a month. So pretty big increases happening over the last few years, from going from 350 to 405 to 460, and twos going from 360 to 420 to 450. Just unprecedented growth. I mean, I'm not gonna go out and say, expect, rents to go up 20% every single year, but I would not be surprised to see them well above inflation for the next few years, as as we deal with, inflationary pressures, as we deal with people getting used to higher interest rates, as we see completions still not match up with demand in the marketplace, given the rise in population, the rise in students. We're getting a huge student population in Toronto, and all the universities are expanding.
I just read a report right before I jumped on this with you. I thought I printed it, but Toronto, Canada, has the most international students than any other country on the planet, and it's a long shot.
Yeah, we're extremely attractive, and I mean, as terrible as it sounds, but the political nonsense that's happening in the United States is making Canada just that much more desirable, right? They're taking away your rights down there, and we're being a much more welcoming place to live. So I only expect that to continue.
Yeah, I agree.
And so I did a quick, a look at, the premium that you might get with a furnished versus unfurnished unit. And again, because there's slightly different sizes for these units, it's not always apples to apples, but you're generally looking at a premium of somewhere around $120 to $150 a month for a furnished unit. We saw is my 1 bedroom plus den, 175 is about what we got there, and 1 bedroom's 125, 2 bedrooms $100. So again, there's some compositional issues here in terms of the sample size, but it just gives you a little bit of a sense of what you might be able to get when you furnish a unit. Some of these small units that you're doing, your furnishing cost is not significant. So it may be a good investment to furnish the unit and get some higher rents.
And I assume this would be based on like a long-term rental, like someone that rented for a year.
Yeah, these are not short-term rentals. Yeah, exactly. Yeah, these
Okay.
are at least a 1-year lease
Right.
product here. Yeah.
Yeah, that's another reason why I actually really like this building is because it is an area that would demand furnished rentals, just because all the transit's so close by and being a trendy neighborhood. But what's interesting with this building is they actually have no restrictions in terms of the amount of the leasing time, so they can be less than 30 days. So, I don't want to get into that whole conversation around Airbnb, but what is interesting is there is an opportunity to be able to do something like that as well. And this is a very well positioned building to be able to even have further, higher furnished rents. I guess those are your slides.
Yeah, that's it. That's the whole kit and caboodle there.
Well, I'm going to jump into 316 Junction. If you have anything you want to add, please jump in anytime. You're obviously familiar with the project and the neighborhood, and really what this is for our clients is it's an opportunity. We create an opportunity, and what we do is, based on our relationships with past developers, we can go in and make a promise to sell X amount of units, and in return, we're going to get X amount of incentives and price discounts or whatever the case may be for our clients. And in this case, we found a really great opportunity in the Junction. And I'll go through all the reasons why I think it's such a great deal. First of all, the pricing is below the VIP pricing, which is exclusive to us. I'm personally going to be investing here. We'll get quickly into the financials, but I'll send you guys a video later really breaking down the financials. But this is a great project for the reasons I'm about to show you, to position it for capital appreciation, which I truly believe is the most important component when you're looking at investment, but also for cash flow based on the strong rental market that we just discussed. So the building is stunning. It's by Marlin Spring. I've actually invested in a number of units with Marlin Spring. I bought 7 actually in their building stockyards, assigned a few, and I ended up closing on 3 of them, which have been doing incredibly well. They're standard finishes, standard amenities. Everything is just very, very well done. You could put it in that luxury market bracket, but this is standard luxury finishes in many buildings would look like standard finishes here. So it's just really well done from an exterior aesthetic, architectural, but also all the amenities and finishes that it offers. Great to live there, great for rentability, obviously. Now, why do I like 316 Junction condos and why do I like Junction? So I always look at the fundamentals. As an investor, there's a number of things you need to look at. And really you want to look at, first of all, supply and demand. I think that's a bigger discussion, but supply and demand is really what you want to look at. And in an area like this, it is undersupplied and there is a tremendous amount of demand to move into it. And that's why rents in this area are so high, which I'll get into. But the average resale in our research, the average resale 2-bedroom condo in the WO2 district, so the district that this building is in, sold in the last 60 days on average of $915,000. So that is the average resale condo price. That's made up of new condos, that's made up of old condos. New condos are valued higher than older ones typically, but that's the average. The average price for the allocation that we're selling, that we have with the developer that is exclusive to us for a 2-bedroom after our incentives and price discounts, is $810,000. Major job growth. So when you're looking at an area where you want to invest, you want to look at demand, the demand side. So what's happening in demand? There is a tremendous amount of job growth coming to this area. Already in this area, there are a lot of tech jobs just around the corner from here. That's why the rental rates are so high. You have Hines that is close to completing a very tech-forward, smart office space, which is a few minutes from here. And there's a lot of jobs that are already here and a lot more that are coming. So that's one of the reasons, one of the big things we always look at. Then another thing is transit. Transit is very, very important because that has always got higher rents and it has always got higher resale prices. And you can look at that trend in any major city around the world, that when you have a property that you own or rent beside transit, you are going to get more money. And this is located steps to three major transits. So we call it the transit triangle just because it has all the transit there. So you've got TTC subways. The subway's a few minute walk from here. You've got the GO train, and you've got the Up Express. So the Up Express is the new train line that connects you to the airport. And then it's a great neighborhood. I won't get into all of it. Most of you probably know the Junction. Ben lived there, or do you still live in the Junction?
No, I'm on the east side of the city now. We're actually really close to another Marlin Spring project called the Dawes. So
Oh, nice.
right behind there. So luckily I worked both on this project and the Dawes with with the previous owner. So I saw it from acquisition and now to see both those projects launching and out in the market, it's pretty satisfying.
Yeah, that's right. So neighborhood, awesome neighborhood, and then AAA rental market. So we're talking about the rents in Toronto, staggering numbers, but what I'm going to show you here is that the rental opportunity in this specific market is incredible. So this chart here on the left is the Campbell. So the Campbell is a purpose-built condo building that is located directly across the road from 316 Junction. And this is their current inventory that they're renting out. And when you look at the building, from a design architectural standpoint, it does not compare to 316 Junction. Purpose-built rental buildings do well, but when you have a standalone condo building that typically has better amenities and finishes, and it's not all renters or some owners, you typically get higher rents in those buildings. So this gives you an idea of just how high some of the rents are, ranging one bedrooms from $490 to all the way to almost 3,000, or I guess 2,800. So we're going to get into those later. I'll send you guys a video where we're breaking down those numbers. We're making some financial forecasts, but I think it's just really important to note this is directly across the road. And these are the rents we're looking at. This data here we just pulled from Trev, and that shows you there the 60-day average for a two-bedroom is 915,000. And then this is the rental data on Trev. So that's a standalone building across the road, which I think is the best data to probably look at. But when you look at, this is just for two bedrooms, on average 2,950, and then maybe one bedrooms. Anyway, if you look at the Trev data, rental market is very strong in this area. So what else makes this very special? So when we look at a building, a project, we look at the fundamentals. We look at why would someone want to invest here? Does it check off all those boxes? Then you want to look at not only the developer and the development and the quality, you want to look at the incentives. And what makes this a very, very exclusive and special opportunity is that $30,000 to $40,000 off of VIP pricing. So the developer essentially is in a situation where we've talked to them and we've promised to make sales on X amount of units that will help get them, potentially in these cases, maybe closer to construction financing, or just want to get a group of sales done, whatever the case may be. But now we've got an allocation of units where we're able to offer this exclusively to our clients. The 5% deposit program, which I think is usually one of the biggest factors when people buy, is deposit. So you're not actually buying a condo today. If you were, you'd be putting down 20%, you'd be paying a mortgage, and you'd be paying closing costs and worrying about all that. But what you're doing today is you're putting down a deposit of 5% in 30 days, 5% in a year, 5% in another year. So it's very, very spread out. So if you're buying a $600,000 condo, it's $30,000 today, $30,000 a year, $30,000 in another year, and then nothing until occupancy when you close on it. And then, it's got the typical free assignment, caps on closing costs, and free property management. Now, my company, I own a property management company. We typically offer our good investor clients 1 free year of leasing services and property management. We love this area. We think it's going to be a very rentable area. We think we're going to find tenants who are going to want to stay there for a long time. There's not going to be a lot of turnover. So we're going to do a special 2-year rental management program. So buyers are not going to have to get their hands dirty, so to speak. And we're going to make this very simple, almost as easy as owning a mutual fund, so that it's easy to invest. And actually, you already went through all this, but this is, I guess, some other data of other buildings in the area, just showing what they're priced at. So, at a high level, the average price per square foot, I think actually before our discount is $1,311. But when you look at the DuPont down the street, it's $1,380. craft residences down the street is 1526, Junction Point higher, High Park, and Oscar residence is around 1500. So there's really good value here in terms of that. How are you doing for time, Ben?
Yeah, I'm good.
Cool. Well, I'm going to fly through this just because this, a lot of my watchers, my viewers have seen this before, but I think just to tie it all together, when I'm buying an investment and I'm talking to clients about investing, we're doing what you and I just sat down. We talked about the market. We looked at the fundamentals and we said, okay, things look good. Things look good in this area. Future looks promising based on these metrics. And that's typically where we start. And then what we need to do is we look at the opportunity, we find an opportunity, and then we kind of apply all of the principles that I've used to build a long-term relationship. And it's what I call the investor operating system, because it's an iOS, it's a system, it's very simple, but the tenets of it is leverage, compound interest, time value of money, and passive income. And the way I've been able to grow my portfolio and use these principles is through pre-construction. Pre-construction, I think, is very important because it allows you to scale. Like Ben mentioned earlier, you're not actually getting a mortgage today, you're putting down a deposit. So if you were to go buy 10 condos today and have to close on 10, that'd be a lot of work. But when you can stagger them through pre-construction over a period of time, use the equity of condo 1 to help close condo 2, and so on and so forth, you're able to create this system that allows you to scale over a period of time. So leverage, I think everyone knows what it is. Buy with the other people's money. Pre-construction, though, is the ultimate leverage because you're not actually getting a mortgage, but you're getting the appreciation of the entire asset. So if you put down 5% on a $500,000 condo and that condo goes up, you've just made that lift on a 5% deposit. Again, time value of money is one important thing. So I think people get caught up on looking at what's happening today and what are the numbers today. And I hope we just showed you guys enough to understand that the numbers do look very promising. But what's important to always realize is that when you're buying, investing in real estate, it's not a quick and sexy way of getting wealthy overnight. This is not cryptocurrency or something like that. This is a very predicted, safe, lucrative way of building serious amounts of wealth over a long period of time. And that's why I like to call it multi-generational wealth, because when you start doing this for 10, 20, 30 years, you're making millions of dollars that you could literally pass on to the next generations. And what this slide does here is it shows you the 45-year average of price growth in Toronto. And then it breaks it down into 10-year increments. And you can see over every 10-year increment that there has been a tremendous amount of growth. So, if you even break that down further, you would see the same thing. One thing I didn't have enough time to actually put together was if you actually look at where we're at in terms of that 10-year average, it suggests that we're probably at the bottom, and there's probably going to be a run in prices due to just the history fundamentals. Compound interest, I've gone over this so many times. I'll just highlight this one thing. Based on a condo investment made 20 years ago with 20% down, today that would be worth $2,163,000. So I kind of break it down, Toronto Stock Exchange, because you can go invest in a stock, but you can't really get leverage. You can if you're lucky, but it's very risky. They could pull it anytime. The beauty about real estate is the time of it, the compound interest of it, but also the leverage of it. So when you're actually looking at an investment, all components over a long period of time, and you're buying, in this case, $430,000 condo in 2002, you would have put down $100,000. And then 20 years later, that condo would now be worth $2.163 million. But you only put down 100,000, that would be a 2,000% return on investment. And there's Twitter haters out there, and I show my financials sometimes, and people just rip it apart. But this is a historical number. This is a trend. This is an actual number. So I'll take it even a little bit further, where I'll show you guys trying to get through this quickly, Bangs. I think your dog wants to go for a walk.
Yeah, she definitely does.
Passive income. I mean, look, I think everyone knows what passive income is. It's money while you sleep, and pre-construction allows you to do more while doing less. So passive income while you sleep is a way to scale and build serious wealth. You know, and then you refi and repeat. So when a pre-construction condo is done, you're able to tap in the money that you just made over the 4 or 5 years, and then you can refinance it and take out 80% of the appreciation. So on average, it's probably around 300,000. You can take out 80% of that, and then you have cash flow. So all of a sudden, the day you buy your condo, people are talking about cash flow is so important. You buy a pre-construction condo in 6 years, when it's ready, you refinance it. There's your cash flow. So if your monthly mortgage payment is a bit less, then you could create cash flow by pulling out equity and just paying it that way. Or you could wait the 2 or 3 years for rents to increase and not be cash flow negative. And I think that's a huge oversight. People just assume cash flow negative is bad. You need to look at the trajectory of what that actually means. This is an example of the multiplier. I won't really get into it. I'll show you guys this quickly, but this is a unit I bought 2017. I need to update this now. Paid 602, had it recently appraised at 1.175, currently rented for 3,800. My mortgage was 482,000. So what that meant was I refinanced it at the value of 1.175. I got 80% of that, which was 940,000. I paid off my $482,000 mortgage, and I got a check for $457,000 to do whatever I want. My cash flow, full disclosure, went negative, and I kept $100,000 in that account to pay that negative cash flow because I know it'll be positive again in about, I think I estimated about 4 years because of rent increases and mortgage pay downs. But what's important with this is now I have tax deferred money, so I don't pay any tax, that I can go use to go and buy more real estate. And this has been the tool that me and many other successful investors have used to scale and build more real estate. And just to give you guys a snapshot, I mean, this is what my real life portfolio looks like. And you know, today it's less than when we did this last time, but today it's a value of $34.7 million. And you know, a lot of that is leverage, and that's fine. But you know, if the market went up 10%. This year, my net worth would technically go up $3.5 million. So this is why it's important to scale, and pre-construction gives you the ease, the ability to be able to scale. You know, and there's ways to do it through financing and everything. I love talking to my clients one-on-one about that. We won't talk about that now, but there is a way that everyone that's watching this can scale a portfolio to this extent.